The major averages seeing gains across the board. The S&P 500 heading toward a possible record close in what would be its 18th of the year. Our next guest, however, sees some cracks forming under the surface for the momentum trade. Let's bring in Jeff deGraaf, chairman and head of technical research at Renaissance Macro. Jeff, it's good to see you. So, you've been pretty bullish for a while, observing that this is a bull market, will probably continue to be so. But take us below the surface a little bit in terms of what your call is on the momentum factor within this market, what it means right now.
Yeah, look, we are momentum players too, Mike. You know that we like trends, we like things that are going up. That tends to be good news, and we tend to play it that way. There are points where momentum will punch you right in the nose, and we ought to be careful of that. And one of the things that we look at is just the spread between the returns of high momentum names and low momentum names. And when we get into that 90th plus percentile, it makes us nervous that the continuation of that trade, which usually represents the consensus call, is probably, running out of gas, running on fumes. And so it's not bearish for the overall market, which I think is really important and frankly refreshing. But it does imply that there is this convergence between losers and winners, mostly because the winners will tend to consolidate, go into sort of a corrective period. Again, not big tops, not a big problem, but I think more frustration for bulls. And then the laggards will catch up. And that's really how we're positioned for the second quarter and maybe into the third quarter of this year.
In a sense, you're kind of describing, I know you've been looking at this for a little while, what the last couple of weeks have felt like a bit. In terms of the momentum factor coming in a little bit, hasn't really destabilized much of anything. But what areas do you specifically think are going to be net beneficiaries if this convergence continues?
Well, from a sector perspective, and there's a little cross-pollination here, so I want to be careful. But if you look at what's represented by the lowest momentum names, you've got healthcare, which is probably the most dominant. You've got some of the staple names. You've got some of the material names. And we have started to see some breakouts there. The relative performance, which we wouldn't expect, isn't very good. But we do think that there's a little bit more left there for those names to sort of catch up in the second quarter. Again, as the Q1 names start to soften, as the semis soften, some of the software soften, some of the Ozempic sort of related drugs soften, we think that there's that opportunity to catch up. So the good news, and I think what people miss around this, is it usually means that breadth improves and the market actually looks a little healthier. It might not be in the things that people are concentrated in, but overall it ends up being a little bit more healthy of a market when that does take place.
Right. And I guess the other piece of it is just how sentiment and seasonal patterns might fit into this. I guess, we continue on this hunt, so far unsuccessful, for some kind of a meteor pullback or some kind of, gut check that says, OK, we can sort of refresh the rally here a little bit. Maybe we don't need it, but I'm wondering what you're seeing there.
Well, I think if there's one thing that is on the edge that has us a little concerned that might be a shift in the narrative is where we are on the 10-year yields. Now, we're not bond bears. Maybe we should be, but until you really get yields up through 440, the trend in yield still looks to be lower to us. That's driven partly by what we're seeing globally. The global yields, with the exception of Japan, still look like they're topping and about ready to contract. But if we punch through that 440 on the 10-year yield, it starts to trigger a bunch of our work, our yield impact models, some of these other things that historically does have a negative impact on the equity markets. And so that might be a little bit of a reset or a rethink for the market. Again, I think it'd be more tactical than strategic. I don't think we're on our way to 6% or some of these crazy numbers that are out there. But I do think it might start to question, people's thinking around the alternatives that they can get in fixed income versus the equity markets at these levels. So that's one of the things that we're keeping in mind as we, kind of search for ideas as to what might be the disruptor here.
And then what do you make of the recent outperformance of things like energy, basic materials, some of this commodity-based stuff that has moved higher? And, I guess you could draw a macro message from that, or you could say it's just a little mean reversion.
I think it's both. I think it's, for us, the relative trends haven't changed. They're not leadership names, but they are participating. So that's welcome because what it really means is that, we probably aren't on the cusp of some global recession or something worse for that matter, even with what we're seeing out of China and some of the concerns there. So I think it's refreshing that it still says that there is demand here. You're starting to break these out a little bit. In a lot of ways, as long as they break out and participate, but they're not relative strength leadership, that's actually a really healthy message because it says that, the productive assets are somewhere else, not just in raw materials, but that the economy is firm enough that they're well bid. So I kind of like to see that. And in many ways, it's a Goldilocks scenario.
Yeah, certainly would better than having them sort of under liquidation. It raises tougher questions. Jeff, great to talk to you. Thanks so much.